Welcome to Marketopolis, at the crossroads of Wall Street and the internet. In a feed-driven era powered by Reddit, Robinhood, YouTube, X, and many other platforms, retail investors drive the conversation online. Corporate access has been blown wide open, conversations move at the speed of social platforms, and CEOs, IROs, and comms teams are rewriting the investor relations playbook in real time. I'm Matt Giuano, CEO of Stakeholder Labs. Each episode, I talk with public company CEOs and top operators to uncover fresh strategies for communicating and competing in today's markets. Whether you hold a single share or just love the story, you'll take away practical lessons for navigating modern public markets. This is Marketopolis. Let's get into it. In today's episode of Marketopolis, we're pulling back the curtain on Dave, a publicly traded fintech pioneer that isn't just challenging traditional banking models, but reimagining financial services for millions of underserved Americans. Imagine a world without overdraft fees, where short-term credit is transparent, accessible, and designed to empower rather than to entrap. That's the vision that inspired Jason and his team when they founded Dave in 2017. What began as a bold mission to fix a broken system has grown into a publicly traded company serving more than 12 million customers, powered by cutting-edge AI and a deep commitment to improving consumer financial health. In this episode, we'll dive into Dave's remarkable journey from a scrappy startup with a score to settle with the big banks to a sophisticated fintech platform rewriting the rules of modern finance. We'll explore how they preserve their founder-driven culture through hyper-growth and going public, their innovative use of AI, and their broader vision to democratize access to financial tools for everyone. So get ready for an inspiring conversation about innovation, resilience, and the future of banking right here on Marketopolis. The future of air travel is fast approaching, and to help shape it, Surf Air Mobility is building a platform to bring together AI-enabled software, electrified aircraft, and a nationwide flight network targeting an estimated $100 billion regional air mobility market by 2035. Their SurfOS software, powered by Palantir, is designed to be the intelligent operating system for private aviation and air mobility. And with over $100 million in annual revenue and the owner of one of the largest commuter airlines in the U.S., Surf Air Mobility is uniquely positioned to advance next-generation technology across the industry. To learn more about Surf Air Mobility, visit surfair.com/Marketopolis. Before we begin, please note that this conversation may include forward-looking statements. These statements are subject to risks and uncertainties, which are described in the company's SEC filings and investor relations materials. The views expressed in this discussion are solely those of the guest and do not necessarily represent the views of the host or the show. This discussion is for informational purposes only and should not be taken as investment, legal, or tax advice, nor as a recommendation to buy, sell, or hold any security. You should always consult with a qualified financial advisor or tax professional before making investment decisions. The host and guest disclaim any liability for losses that may result from reliance on this discussion. Remember, all investing involves risk, and past performance is not a guarantee of future results. Welcome to Marketopolis. Today, I am joined by Jason and Kyle from Dave. Would love to have you guys introduce yourselves and the company. Maybe Kyle, if you want to start, and then we'll hand it over to Jason.
Sure. Yeah. Kyle Beilman, CFO and COO of Dave. Been at the company for over 8 years now, so seeing it from pretty much day one all the way through going public in the last few years as a public company, which I'm sure we'll get into, but it's been an interesting ride. But prior to Dave, started my career as an investment banker, doing mergers and acquisitions and kind of strategic advisory type work for large cap tech and media companies. Did a stint in corporate strategy before coming to Dave, and kind of been here ever since. It's been a lot of fun.
I love it. Jason?
Yeah, founder, CEO of the company. Started Dave back in 2017 on a real mission to disrupt overdraft fees. And here we are nearly 10 years later. Company is helping over 12 million consumers at this point. We're one of the largest neobanks in the world. For those not familiar, neobank is sort of digital first, bank-free strategy to disrupt incumbent banks. And where we differentiate is on short-term credit. We allow people to access money for gas and groceries for as little as $5, and that's been a staple for the business. Leading with credit, always as a way to drive customers in the front door. It's been a wild ride.
So maybe set the table for our audience. You talked about what neobanking is. Who's your customer set? What are customers looking at as alternatives, or maybe what are they switching to Dave from? What does that universe look like?
I'd say our customer we describe as underbanked. This is a customer that's not being served well by incumbents. They are customers that typically don't have a high-end credit card. They don't have a prime credit score. And so by virtue of that, they're one of the customers that the large banks have to charge overdraft fees and minimum balance fees on just to break even. The JP Morgan consumer CEOs talked a lot about it's $300 is their break even on a customer just to maintain a basic checking account once you factor in branches and the legacy tech stack. Just think about a company like Dave, digital first, built all of our own technology, no bank branches, and so our cost to serve is less than $40 per year. Mm-hmm. So we have a long-term cost advantage for the versus the banks, which means I can deliver a better experience, faster, cheaper. That drives just better brand awareness and ultimately a much cheaper CAC as a result of the better economics for the user.
So that's kind of where you guys are at today. Maybe rewind. What was the inspiration for this business? Jason, you're a multi-time entrepreneur. You've built businesses before. What really sparked your idea to launch Dave?
Look, the best companies are started by founders that have a bone to pick with something. And for me, that was overdraft fees. Being a serial entrepreneur was very hard getting started. You don't have consistent inflows and outflows in your account, and you're going negative on your checking account quite a bit. And that led to being charged hundreds of dollars of overdraft fees. I figured if I was doing it, probably a big problem for other people as well. It was always a problem in the back of my mind. Didn't have the resources really to go after such a big industry. So I started with a smaller company, was fortunate enough to exit that in 2015, mm-hmm. and had a little more liquidity to go after a big solution. And so I took a very different approach to building Dave in the sense that I knew that starting off with a full-blown checking and savings account was going to be a tough ask. Mm-hmm. We know banks, it costs them hundreds of dollars to acquire customers. It's not something people aspire to do in the morning is change over all their bills. It's hard to win. And mm-hmm. there was a lot of neobanks prior to Dave that had launched that weren't very successful. In the early days, Bank Simple mm-hmm. was something we all kind of heard about, but didn't get a lot of traction beyond 100,000 or so users. And what I really believed was that all these existing players ignore the opportunity to offer people short-term credit. That's what people really wanted. Yep. They liked the idea of overdrafting their checking account. They just hated paying $34 per instance. Okay. And so the original idea was we're going to start by offering the short-term credit actually for free. Mm-hmm. So you could borrow money for Dave for literally no cost and just give us a tip if you were happy with the service. That's how we got launched. That's how our CAC was incredibly low. And we've migrated now to a more simplified fee structure where every time you borrow $100, we charge you $5. Still incredibly cheaper than the incumbent banks, but nonetheless, starting off with a short-term credit message was what set us apart from everyone else, and it's still how we go to market today.
I think that piece of being the founder and having that continuity through the process all the way to becoming a public company is super powerful. I'm actually curious, Kyle, on your side.
Yeah.
When did Dave hit your radar? How did you get convinced to join? What did that look like?
Well, yeah, maybe even before that. I started my career as a banker because that was the easiest or most straight line path to becoming a private equity or hedge fund investor, and that's what I thought I wanted to do. Mm-hmm. But I'd say pretty early on in my career, I decided I wanted to be more of a builder and an operator as opposed to, on the investment side of the equation. And I had built a very close relationship with one of the partners at the investment bank that I worked at, and he had invested in Jason's last couple companies. And for a number of years before I met Jason, he was always, you need to meet Jason, you guys would hit it off. And, this was, I guess, late 2016. I was working a corporate strategy job at the time, and I was kind of looking for my next thing to do. And he's like, you guys need to meet. He's starting to work on this really interesting business. I know you guys would be great partners. And so we met for the first time, I think it was October of 2016, right when the core team of Dave started, really working on the problem full time. Super excited about the opportunity. From the standpoint, I think, especially then, Fintech was kind of or financial services in general was kind of the last frontier that the internet had yet to kind of fully disrupt. And excited to kind of take on that problem. He and I hit it off. Unfortunately, at that time, I wasn't a coder or developer or a product person, so not much for me to do, but we stayed in touch over the next, 6 to 8 months there, and it launched in the App Store in April of 2017, and came in one day, and, we figured out a way to make it happen. So, yeah, it's just a really good partnership from the start. But I mean, I'd sort of describe it as, three things that really excited me about the company then, which was, I think, hard intellectual problem to solve, just credit, neobanking. It's a difficult business. I think you can really feel good about the work that you're doing and the customers that you're serving as well, and to do it with really good people. And those were the three things I think that really drew me to the company from the beginning, and I'd say very much the same thing today. It's what gets me excited to come to work every day.
It's fascinating. So it sounds like being involved from the earliest stage, even in some form of advisor capacity. I'm curious, what kind of advantage do you guys feel like that gives you guys? Obviously, founder of a public company, but also on your side, Kyle, kind of being there from the beginning and understanding the mission and the ethos of the company itself. Now, being a multi-billion-dollar publicly traded company, what advantage does that give you guys compared to someone who might be more of an operator brought in after the founding and not have that tie back to the core mission?
I think having again, going back to what sets the best companies apart is when you have a founding team that really has a bone to pick with a particular industry that they have personal pain points with. I think we carry that forward through. Even when Dave had some early troubles in the public markets, we never wavered off helping serve our customers. And even though the company was trying to figure out its valuation trajectory, we always went to bed at night knowing that we're helping millions of customers pay for gas and groceries. And at the end of the day, that's really all that mattered. And if you look at the churn we had in our team throughout that, it was so little. And I think that speaks to having a real clear mission, vision, strategy, and audience that you're really going after, that your company and team understands, because that's, the valuation is only a small part of the story. Obviously, it's important, but it's not everything.
So let's talk more high level of how you guys approach philosophically going from private to public.
Yeah.
Maybe that.
Yeah, so I think first and foremost, showing investors that we have a highly scalable platform that has operating leverage built in, I think was really key. That was part of the challenge we had in the early part of going public, was that people really couldn't see the forest through the trees, that we could ever get the company profitable. And once we started to have a very clear investor message that once we reached 2.1 million monthly paying members, we'd reach profitability. And that's not really something you really do as a private company.
Sure.
I think the importance of having a crisp message that thousands of investors can understand is different than trying to convince one venture capitalist that you're worth X. And so I think that was a major learning curve we've had, but I think we've gotten really good at it now, entering almost year 4 of being a public company.
Let's double click on that, because it is very different. So Kyle, from your seat as the CFO, how do you think about preparing for an earnings call? How do you think about communicating to the market? Maybe even going back to how did you do that pre-IPO to your existing investors, and then what's that transition look like?
Yeah, I mean, I think it starts with a very crisp investor narrative. I mean, we try to break down the business into a way that's very digestible for people to understand. I think our package that we put out to the market is also pretty comprehensive, maybe compared to some companies. But, we're big advocates for transparency, and I think giving people the information that they need to make, informed investment decisions about the company. We're also very available, I would say. Both Jason and I spend a lot of time on IR. That kind of goes back to the, some of the lower points that we've had as a public company, really needing to invest a lot of time into those relationships and build trust with investors. That I think was an uphill battle as a de-SPAC business and an unprofitable one for a period of time. And really just the relationship aspect, I think, is super important, and maybe something that's not as understood from the outside, that the relationships with the street are super critical. But yeah, in terms of preparing for an earnings call, might be what you expect. Try to highlight the things that I think make sense and are durable, and the sort of key trends that people should really key into. I have a kind of a philosophy is like never try to talk about more than 3 important things for a call, and it's like the 3 most important things you want people to take away from your press release. And just trying to sort of keep the information or cognitive load as low as possible when you're kind of telling the message. And then I think from like a guidance philosophy standpoint, kind of going back to the trust piece, We've taken just a very conservative approach to how we put out guidance, ensuring that we put out numbers that we have a lot of confidence in hitting. And I think we've done a good job of that over the last couple of years, but it all comes back to this trust and credibility piece. We want to do what we say we're going to do, and I think that's underpins a lot of what we try to accomplish on the IR side.
Looking at the communicating with the market side and looking at being a public company, the other side of that is you have your day job. You have to actually run the company and continue to grow. So how do you guys personally think about balancing that? You both have families. Like, there's only so much time in the day. How do you balance running a public company operationally and then also communicating and navigating the markets?
I'd say most of the work of running a public company comes sort of in the lead up to the earnings call, and then the following couple of weeks when we go on the road. Typically, we're very consumed with a bunch of investor analyst conversations, but after that kind of dies down, we get closer to the quiet period, we tend to shift back to operating mode and spending a lot more time on product roadmap, operations, and feel like there is plenty of time to work on both.
Mm-hmm.
And it is, I say this to people, but the IR work that we do and the road shows we do are optional. I mean, we choose to do them because it's the right thing to do to build the relationships like Kyle talked about, but we don't have to do all those as much as we do if we feel like we need to shift gears and spend more time running the business.
But yeah, maybe just to add to that too, I mean, I think we've invested in a lot of, even before I get to the process piece, it requires a really good team as well, to make sure that, things sort of stay on track while we're investing the time and energy that it takes to, go on the road and tell the story and spend time with investors. So hiring, managing, building the right team, I think is super critical for that. And then from a process standpoint, we've got a really good rhythm where, every quarter we do our quarterly business review, followed by our board meeting, followed by earnings. So all that stuff sort of compounds and cascades from one another, starting with the operational piece, because none of the investor and IR stuff matters if we're not executing, and that always comes first.
I love it. So maybe looking at going through the going public process, what's something that no one tells founders? So you're a founder, CEO of a publicly traded company. What's something, a challenge, something that other founders who might take their companies public someday should be thinking about?
I think the thing we didn't have enough appreciation for, you can weigh in here, Kyle, but just the importance of the analyst coverage early on. That was one of the downsides of going public via SPAC in a sort of challenging macro environment, was we just didn't get the coverage from the major banks that we would have otherwise gotten in a traditional IPO. And so at one point we had no analysts covering the stock, which is a tough place to be. And we had to really go around and build relationships with small and mid-cap banks to take a bet on us that it's worth their analysts spending time on our business, even though they didn't make any money in our IPO, and there may not even be a path to doing a capital markets deal eventually. And so I think that was something we didn't have as much appreciation for, that in hindsight we would have definitely prioritized if we were to take another company public again.
Yeah, I guess, Kyle, anything to add on that? It was your first process as well, and being in that CFO seat, curious your perspective.
Yeah, I mean, for me, it was a learning curve just on terms of, how the different stakeholders across Wall Street work. I worked on the M&A side, so not on the capital market side, and just less exposure to, spending time with the sales team and effectively how you get distribution through those investment banking relationships on the capital market side. I just didn't have a great appreciation for, and that's been a learning curve, but, sort of comes with the territory, and not something that is overly complicated or anything like that, but just something you need to have an appreciation for, because there can be a lot of benefit from those relationships.
Yeah. Maybe going through that process, did you guys look to other companies, leaders, founder CEOs, new first-time CFOs of public companies for inspiration, guidance, mentorship?
Well, we're fortunate enough to have Mark Cuban on our board since the inception of the company, and he was helpful through those times. Even though he stepped off the board at the time of going public because he didn't want to be a public company director, he was still there for us when we had questions about what path should we take the company, even when we're at our all-time low price. So he was very helpful in that. And think I had a call into the SoFi CEO. It was helpful at one point to say, what do you think's going on here? And we kind of unpacked our story together and helped us craft a little bit of our message, given his former background on Wall Street. So, yeah, we tend to call on other CEOs if we think we need help, or CFOs. We're not afraid to ask questions.
And then fast forward, you guys are a public company. One thing I ask all the CEOs, CFOs that come on the show is, you're operating day to day, you're navigating a public market. I'm always curious, how do you check your own stock? Do you have the stock app on your iPhone? Do you have Robinhood? Every CEO says, we try to tell our people, don't look at the stock, just keep your head down, and we try not to look.
Yeah, that's unrealistic.
No, everyone looks.
Everyone looks.
How do you check your own stock? What's your go-to? Do you have an app of choice that you use?
I'm still just a basic Apple News.
Yeah.
Or whatever the Apple stock app is. It's the easiest one on my phone, but then have to dig in further on news and other places.
Okay.
Yeah, my wife actually bought me this little box thing that's...
is it the ticker box?
It's the ticker box, and that sits on my desk.
Okay.
It probably shouldn't from like, mental health perspective, but that's what I use.
And double clicking a little bit on this, Jason, you mentioned other information sources. What's your information diet look like? Are you guys subscribing to newsletters? Are you listening to podcasts? Are you getting more comprehensive reports from some of your advisors around how you guys are doing, how comps peers are doing? What does that look like for a public company CEO and CFO?
We'll certainly read all the analyst coverage of the 10 banks that currently cover us. Super helpful to see where they're at, where their models are. But I think growing trend of some of these retail investors that are writing these Substacks, and there's some really intelligent stuff out there that we find actually pretty valuable and read it.
Yeah, I'm on X quite a bit, and so follow a handful of investors on there. People are pretty plugged in with the markets. Big pot on podcasts as well. Try to listen to other founders, within the industry, and investors too. And the sell side coverage for us and all of our peers as well, to try and pick up on what's going on in the industry overall. And a handful of newsletters. So I'd say as much as a lot of reading and listening as much as I can.
On that X piece, that Reddit piece, shifting gears a little bit, getting into retail, curious, how do you think retail investors are discovering Dave? You talked about the institutional analysts and how you had to make an effort to get on their radar, but how do you think the average retail investor, maybe on Reddit, maybe on X, or just a Robinhood user, is finding out about Dave?
Good question. We probably haven't done enough from like a direct kind of strategic messaging standpoint to get ourselves in front of that particular audience. Certainly think there's more to do there. I have tried of late to engage a little bit more with some folks on X, just responding to tweets and whatnot. But I think just given the trajectory that the company's been on over the last couple of years as well, it's kind of pushed us onto some people's radar screens because the stock's done well, and I think people look at those sort of breakout stories as interesting, and so I feel like there has been a lot of organic interest just as a result of that. But I've just been trying to post a little bit more here and there and engage with people.
One of the trends we see is retail is starting to get access to institutional grade tooling. The AI toolkits that these investors have today out of their spare bedroom is getting closer and closer to what Wall Street has at their disposal. So maybe a broader question, but how do you see AI impacting the financial markets and also the dovetail into your own business? How is AI affecting your own business?
Well, I think AI, when it comes to financial advice and information, we want to make sure we're optimizing so Dave does become top of mind when people talk about what should I be putting my money into, what's a great group stock opportunity from here. We haven't yet thought a lot about how we optimize for that, but I certainly think as AI becomes more pervasive and financial recommendations, we want to make sure that we're relevant.
And then shifting gears to like your own business, maybe just more generally, how are you guys deploying AI across the operations of the business, the product? How is this impacting your ability to grow as a business?
Well, we like to say that we're really an early player in AI. We've been using AI in our underwriting since 2019. I think the amazing part about our business. We really pioneered cash flow based underwriting for approving people for short-term credit.
Okay.
Not using your FICO score for approving it, purely based on your income, where you work, types of places you shop. And that gives people who otherwise are thin file or establishing their credit score, or maybe have a bad credit score, get approved for amount of credit to go buy gas and groceries that otherwise would be rejected for or massively overcharged for by their bank. And so when you layer in AI and marry that with this deep bench of cash flow transaction data, really is the perfect marriage. And we've seen that step change reduce our loss rates over the last 5 years since we introduced it. And it's now led to nearly 1% loss rates after Q2.
Wow.
Again, not using FICO at all and based entirely on our own proprietary model. So it's a pretty special thing we've developed, and we're building a pretty tremendous moat here with the company.
Yeah, it's super powerful.
Yeah, and we have other areas where we've integrated in just more of our operational workflows as well. I'd say maybe more of the table stakes things like you might expect: code generation, customer support. I think we're pretty early adopters though for marketing creative use cases. We had an interesting case study in our last board meeting where we, a lot of our advertising is user generated content style, ads, and typically takes us about 90 days to go from brief to in market or market ready sort of creative. And we've gotten that process down to about 30 minutes now with some of the AI tools, and it can be hyper personalized, and we can run different ads if that we're serving them in different markets and things like that. So I think the speed and cost of creative production has come down a lot for us. I'd say other areas where we're really interested in investing more in capabilities is how do we just cut speed to decision making down as much as possible, using certain AI analytics tools to distribute and kind of democratize data access to say non-technical folks within the business to solve some of their own problems and just really cut down that speed to decision making. I think that's where we see a lot of opportunity to just accelerate the company overall.
Yeah, it kind of sounds like you guys have leaned into a lot of efficiency technology unlocks across the operational side, across the product side. Do you ever feel like some of the challenging times you guys went through the last few years have built a level of resiliency, and you guys operate that much more efficiently than the next person because you guys went through some tough years?
No doubt. I think it's a little bit of both. I mean, we never want to go back to a world where the company is valued where it was. So there's a part of it. It's a lot of operational rigor we built in to make sure that we're never going back there. But also, I think AI has just been a great enabler to unlock the efficiencies that we just don't need to overhire to achieve all of our growth plans. And that's a pretty, I think, unique place to sit. Okay, we're 300 employees now. We were 300 employees when we went public, and we've grown the heck out of the business. So it's pretty impressive to watch.
Yeah, maybe going back to some of our earlier conversations, what's changed as a public company. I actually think it's brought a lot more rigor to the operation overall. I think when the team understands that, we're accountable for putting points up on the board every quarter, it just brings another level of kind of pressure into the system that, just doesn't exist otherwise. So I think from that standpoint, it just helps encourage the discipline.
And even beyond that, I saw on social, I think there were a few call outs of you guys are one of the maybe youngest companies, is it described, to have like a stock buyback program. You guys obviously yourselves are young executives amongst your peers. So there's a different way of doing things, but also it sounds like it may have been a forcing function given what you guys had to go through.
Yeah, absolutely. But, I think to your point about the buyback, we probably, on the very short list of management teams that have as much skin in the game as we do. I mean, we were one of the probably most capital efficient companies to get public, and through that, we've been able to maintain a lot of our ownership stake in the company over time, and we're believers long term, and so we have been buying back stock. This year we spent close to $50 million reducing our share count year to date.
Wow.
And see buyback as a way to just create shareholder value from a capital allocation standpoint that's really important part of the toolkit. So we'll continue to look at that kind of opportunistically relative to other areas of organic or inorganic investment. But we certainly view that as a very important part of the kind of the corporate finance toolkit to create shareholder value.
Mm-hmm. Yeah, part of that optimism too is just we're so early on in our penetration of the TAM. We're 2.6 million monthly transacting members at this point. We believe there's 150 million people up for grabs in this space that could use a better checking account, that could use better access to short-term credit, and not to mention the long-term roadmap we have to do more with the customer base. So we're just very bullish on the business overall. And to point out, we're pretty young too, and so we got a long time to keep growing and compounding this business.
I love it. Maybe going a level deeper on the space. You guys have a unique position in the space. We're also in this era of traditional finance, decentralized finance. It feels like there's a new shiny object in the finance landscape every other week. How do you guys think about how this space is growing? What role do you want to play in that? I saw the open banking side of the ecosystem is important. What role do you play in the ecosystem? How do you see the space going, and where do you want to live within that space?
I think the unique part about the sort of fintech winter that happened in 2022, 23 is it just really cut out a lot of the venture capital dollars going into the ecosystem. We think about Dave being a poster child of success in the neobank space, and we're sitting there with 12 million customers and we have a $50 million market cap. Not the most exciting thing for a venture capitalist to go back. And so we saw just a real large shrinkage of dollars flowing in, which ultimately led to bigger winners at the top. And so I think Dave plays a very important role as one of very few winners in the neobank space. And we think about Chime and Cash App as our two peers in competition in the space, and we're both acquiring, or all three of us acquiring, millions and millions of customers per year. It's we're very grateful in the position that we sit at and the influence we have on the market.
You touched on the open banking piece, and I think that is one of the key differences of our model relative to the companies that Jason mentioned, which are more closed ecosystem models from the standpoint of extending credit. So Dave works for you whether you have your direct deposit coming into our account or not. And so the fact that we can work with someone that wants to continue their primary bank account at Chase but wants access to other types of tools around credit, like we're happy to support them with that. And we just think if you sort of extend that out over time and some of the other product adjacencies that we're looking at, the number of people that are willing to connect their account to get access to a product versus willing to switch their account in order to get access to a product is just much bigger. And that we've built our capabilities around this open ecosystem model just gives us a distribution advantage over time as we think about new product.
And that would be a much more customer-centric approach that the customer should be able to choose.
That's right.
And have a lot more flexibility and optionality.
That's right.
But that also shows up in that fast speed to value, where you can come and Dave get access to credit within 5 minutes of joining, drives such great word of mouth. 30% of our acquisition is still word of mouth.
Wow.
And it's been that way since the beginning of the business. And a large part of that is because we're meeting the customer where they are in their journey. We're not putting this big paywall in front of them to be their primary bank. We want to earn their primary account over time, realizing that we're best at starting off the journey with the credit side of the equation.
So you guys have been through a journey as a public company, but it sounds like you're at a point now where you can start thinking longer term again, and you can start making longer term bets. Would love to hear a little bit about what's the longer term vision? Where do you guys want to go over the next 3, 5, 10 years?
First and foremost, I think that we have a long road to run on our existing product roadmap. Extra Cash being at only 2.6 million monthly transacting members, still a huge room to run there, because we just believe more people need access to credit for things like gas and groceries, especially as you think about interest rates, tariffs, things of that nature that just make everyday cost of living more expensive for the everyday consumer. I think what's really unique about our business is the underwriting engine that we developed. We think there's a real moat there. We call it Cash AI.
Okay.
And that is effectively when people connect their checking account to us, we're able to gather about 6 to 12 months of their past checking account transaction history. That feeds an AI model, which then is amazing at risk splitting to figure out commonalities of fraud or good risk to approve the right customers, and importantly, approve them for the right amount of money. And we've proven now that we've issued extra cash 150 million times at this point, given the fast duration. And we've done so with loss rates nearing 1%.
Wow.
So we think we've really earned the license to develop a product roadmap to meet more customer needs around duration. So because our product today, extra cash, is due every sort of 8 to 10 days, it aligns to your paycheck cycle. That lends itself usually to people using it for income smoothing for non-discretionary expenses, gas, groceries, rent. But through that data, it's interesting, we can see a lot about our competition. And a lot of our customers are using buy now, pay later. And so we know that our members aspire for slightly longer duration. If you want to buy a plane ticket, you need to buy books for school, starting to leak into the non-discretionary items of which we have 0% market share. And so I think that's an exciting area where we feel like we have license to play, and that's a big part of our roadmap to just make sure we are covering the broader part of the credit spectrum for our members.
It sounds like you built a lot of that in-house. What does that calculus look like? I'm sure there's off-the-shelf products that you guys could have explored to help with that. How do you make those decisions to build that versus buy it?
Well, it's such a unique solution. Certainly the short-term credit solution where we're giving people money between paychecks, there was no off-the-shelf version of that we could have adopted. We had to really build it in-house, and we knew that FICO was never going to be a great proxy for whether someone could pay back $50 2 weeks from now. That's really more indicative of you can take on a personal loan or a mortgage, which I think FICO plays a certain part of the market. But when it comes to underwriting such a short duration product, we feel like the merits of your checking account and income data is far more powerful than some antiquated score that really is looking back on prior history. I mean, we're seeing real-time trends in your cash flow information. We know if your paycheck is less than it was last time, did it stop coming in, are the things that indicate job loss. Those are all variables that a FICO would never have insight into. So that we feel like carries itself forward into slightly longer duration where we feel like cash flow data does have a meaningful advantage, and building that ourselves was the best way to go.
Yeah, I mean, just even abstracting it one level up from that, I mean, how we think about buy versus build in general is build orients towards areas of the business where we think we can create durable advantage.
Sure.
And so understanding, what parts of the business that applies to versus us, maybe a more tactical part of the stack where, it just makes sense to buy or rent versus build, as, I'd say how we think about it at a high level is where those sources of competitive advantage and differentiation, we're going to build that.
Yeah, that makes a lot of sense. Guys, we're going to shift gears a little bit around kind of personal philosophy with money, personal philosophy around leadership. So to kick things off, we have a lot of retail investors that follow the show. How do you think about your personal investment philosophy? Are you guys investing in individual stocks? Do you guys have a brokerage app that you're making plays? Are you more index? Are you doing more on the private side, investing in startups? How do you guys think about that?
I'd say for me personally, I'm so heavily invested in Dave that any liquidity I've seen previously tends to go in fairly conservative stuff. So sort of not ETF, but more of a direct indexing strategy to take advantage of the ability to tax loss harvest. Also in sort of tax-free municipal bonds. I'm not saying I recommend that for everybody, but when you're in a high risk position where you're over indexed on one particular stock like Dave, I need to be a little bit more conservative elsewhere in my life.
Yeah, I'm a little bit of a mixed bag. I have a lot of, I own the Qs, I own the S&P, but I also have a handful of individual stocks, mostly tech oriented, and a handful of fintech names, just because it's something I feel like I understand. And, when you look at companies like Affirm and others who were massively oversold during the kind of 2022, 2023 timeline, it's hard to, ignore those types of opportunities where I feel like I have a decent understanding of where the space is going sort of over the medium to long term. And, I'll buy individual stocks where I feel like I can, have maybe a unique perspective around.
And are you Schwab? Are you Robinhood? E-Trade?
I'm a Fidelity guy.
Tried and true.
Yep.
Okay.
I do have a Coinbase app, so I have a little bit in crypto, maybe, single digits of my total portfolio in Bitcoin. And I use Coinbase for that. And
I'd imagine some of this is almost product research for you guys. You try to stay abreast of the latest and greatest, and you're
100%.
using these technologies to know how others are building this. Maybe relatedly, are there companies that are inside or outside your industry that you look to for product cues, or you feel like are doing a really good job? Again, could be fintech, could be outside.
It's not really product cues we take, but we do have an appreciation for the product velocity at Robinhood. They seem to be shipping tremendous amounts of product. I'd say we're slightly envious of that. I mean, we're still very much a single product company. A lot of that's by design because we had a duty to shareholders to get the company profitable and scaling and prove out the operating leverage. But we do want to make sure that we're paying attention to R&D development and stepping our foot on the gas on new ideas that we think we can leverage a lot of the platform we built to ship that. So it's not like major investments here that need to happen to do so.
Yeah.
Yep. Maybe from like a leadership standpoint, I think Coinbase has done some interesting things. Listen to a lot of what Brian has to say about kind of running and managing the company and try to take some influence from them. I think they've done a good job.
Yeah, he has a very direct approach to communicating to the markets. Looking at retail investors, so a lot of our audience is retail investors. We do have some professional and institutional guys and gals that listen to this, but curious, if you had a message to retail at the moment you guys are at, what would you tell them looking forward with a company like Dave?
I'd say simply put, just we're very small penetration of the overall TAM. So just even focusing on our core business, a lot of room to run. And then second, we're so under monetized in the form of there's so many new things our customers are clamoring for from the company that our roadmap is still very underdeveloped to where it could be over the next 5 to 10 years. And so if you think that we have a scalable platform of which we can develop new ideas and we're early on in the TAM, it should be a very solid equation for just earnings potential, which should show its face and translate to better stock price.
Yeah, I mean, just to echo that, I mean, sometimes we get feedback that people say, oh, they missed it because they didn't buy it at $5 and didn't buy it at $20 or $100 and now it's $200. But just based on to dovetail or piggyback off what Jason said, if you can underwrite, I think even a modest growth trajectory of the company over the next 5 years, the amount of flow through that we have from gross profit to earnings and free cash flow is just so high because of the operating leverage that we have, and we still think that there's just tons of room to kind of compound over time. So that's what gets us excited as shareholders.
I love it. Last question, guys. So let's project 5 years out. What's a non-financial KPI or state of the business that's going to really show you that you were successful in accomplishing what you guys want to accomplish the next 5 years?
I think it's our just total monthly transacting members ultimately is the number we look to as a non-financial, just showing that we're doing a good job. We're penetrating the TAM further, and if we can do that while achieving our product roadmap, I think we'll be in a very good place.
Okay, great.
Yeah, 100%. I mean, we operate in a competitive environment and people vote with their feet. So if we can continue to compound user growth, that tells us we're delivering a lot of value for our customers. And I think we'd look to that metric as an indication of success.
User growth. We'll wrap up there. Where can people find you online? Assume your investor relations page for investors, dave.com for interested users. It sounds like, Kyle, you have a Twitter account.
I do.
I assume both of you have a LinkedIn account. Any other socials we want to shout out?
Those are
That's
it.
about it.
Yeah.
Cool. Well, thanks, guys. Really enjoyed the conversation, learned a lot, and hopefully we'll have you on again in the future.
Thanks so much.
Yeah. Thanks for having us.
Thanks for tuning in to Marketopolis, powered by Stakeholder Labs. If you enjoyed this episode, make sure you're subscribed so you don't miss upcoming conversations with the leaders shaping modern investor relations.